I think in order to be a tax saver, you have to have some motivation and you have to be disciplined and you have to have some knowledge. And so I think your motivation really is that there's an ability to pay the least amount of taxes possible if you plan for it. And the knowledge is what you have to go out and you get. So just like you go and you get continuing education to make sure that you're doing the most updated styles or the most updated technique for what you do in your trade, you also have to go seek knowledge about how to manage the business. And if you have the discipline and you have the knowledge, then you can reap the rewards from that. Well, that's what's fun about being a tax person in the salon space is that you get the opportunity to what I call audit proof tax returns. Okay. So if I see a tax return, I also can get a copy of Salon software. I can also get a copy of QuickBooks. And so what I'm doing when I look at a tax return, and as all tax professionals should do, is I'm trying to make sure that matches. So one of the mistakes that we see oftentimes is that because it's a cash intensive business, that maybe the salon software will show that there are more receipts, cash receipts coming in than maybe what's in QuickBooks, what's been recorded in QuickBooks. If those two don't agree, then I automatically have a red flag. And I'm thinking, okay, what is going on? And obviously, it all needs to tie into the tax return. So if I was an IRS auditor, which would be dangerous for this industry, I would be looking at that. And as a tax preparer, I would expect your tax preparer to be asking those questions. They need to make sure that when you sign that return, everything is squeaky clean, I guess. And that's really just on the revenue side. You know, the IRS has an entire chapter in their audit guide that focuses on the beauty industry. It's called Chapter 10. You can Google it and find out how the IRS would figure out if you were not reporting all your money in. Another thing that I see with money out is deducting things that shouldn't be deducted. Travel expenses are a big one. Travel for things like going to shows and meals while you're there, airline tickets, the fee to go to the show, those things are certainly deductible. Now, with meals, there are some limitations, but what oftentimes we see is someone will maybe couple up a family vacation with it, and then they'll try to deduct the whole thing. And we like to say, you know, if the bait's worth more than the fish, don't go fishing, right? Because in a sense, what can happen is you're trying to take a deduction for what's really a personal expense. And if that's the red flag that brings the IRS auditors in and you're doing other things, then that creates a distrust issue. So be very, very, very careful about that. Now, I would encourage people that if you're traveling, take your family. Make sure that you make part of the day about being at the show and part of the day about maybe go around and learn about customer services, some of the great places that you want to go visit. But some of that certainly still is personal expense. And not every meal where you pay for food for your 6-member family team or family is going to be deductible. So that's really important. The other thing about money out that I think that we see as a risk area is autos. So one of the biggest mistakes that we see is people trying to deduct 100% of an auto when they're using it for commuting. So commuting to and from my primary place of employment is not a business expense. Now, if I have multiple locations, commuting to that second location probably is a deductible expense. What we see most of the time that works really well is mileage logs. So if you keep a mileage log for when you go to the supply house or you go to get your mail for the salon, go driving to a show, and then pay yourself back the IRS mileage rate for that trip or those trips, that works very well. And it's automatically a deduction. You just have to keep really good documentation of it. But buying a $70,000 vehicle and then trying to take it all as a deduction when really it's just driving you to and from home doesn't work. As a salon owner, I think it's important that you understand that expenses are deductible if they're ordinary and necessary for carrying on your trade or business. So, ordinary and necessary for carrying on your trade or business. So, if you can take an expense and make it a business expense, then that makes it deductible. So, it's really important that as you think about the things that you're doing, if there's an opportunity there for you to make that deductible, that you do that. Having good documentation in place is very, very important to do that. But one of the things that we see is that that documentation's not in place. And so if you come back from, say, a trip and you tell me that you went and you did these things that were business related on the trip, but you don't have any documentation to back it up, then that makes it very hard to defend it. Now, that doesn't mean that you may not be able to take the deduction, but it certainly means that if you get audited, that you could run into some problems. Now, obviously, you have other vendors that you're paying. So, let's say you have paid somebody to come in and paint the salon. Well, the first thing that you want to do is make sure you get a W-9. Now, why is that? The W-9 gives you the information about that person or that company that you're paying. Now, why do you need that? At the end of the year, if you pay that person or that company more than $600, as the current law states, you would need to issue a 1099. Now, there are some exceptions to that. But if I'm an entity that doesn't want to pay income tax on what you're going to pay me to paint, then why would I fill out that W-9 6 months to 9 months after you paid me to paint? So it's very important to get that W-9 up front so that you know you can be in compliance. The IRS recently changed the fines for not filing 1099s. Currently, that number is over $200 for the copy that's supposed to go to the person or the company and the copy that's supposed to go to the IRS. So that's over $400 for not filing one form, okay? What we see a lot of times is that people just simply forget to file 1099s. Almost everyone has at least one 1099 that they would need to file. It would be to their tax professional. It would be to maybe your attorney, or possibly you're paying rent. So let's say you're a booth renter and you're paying rent to someone. You should be giving a 1099 to your landlord. Now, there are some exceptions to that. Make sure that you understand the rules, but that's really, really important.